Nvidia ended yesterday down nearly 2%. However, when we do take a look, still year to date up an incredible 154%. And we also see Wall Street sticking firm with their strong buy rating. Now today we are going to talk about our price prediction for this company over the next year, and we can see right now it is trading at a fairly costly 46.43 forward PE. Now, when we take a look at this company in terms of their earnings, where they've been and their projections, well, they have beaten over the last 4 quarters. Their earnings is upcoming, so over the next month, we will see their Q2 2025 results being released. And if the expectation is beaten again, well, we can clearly see triple digits, 135% is expected to be the increase to the earnings per share year on year. Now, if they hit all of these targets, essentially in January 26, the EPS estimate of 360 will therefore mean the forward P will drop down dramatically to around 34.92. Something to consider if you do believe that they will be able to beat given their history. Now, when we take a look at how well they performed, well, in the last earnings report from May this year, what we can see, the big news was that the shares, in fact, went well above $1,000. Obviously, now there is that stock split, so it is a lot lower. But essentially, they reported some very strong earnings that meant the share price continued to surge. And one of the key points that the CEO did mention here was essentially that their generation AI chip Blackwell should be seen in their revenue numbers over the next few quarters. So definitely something we will need to look out for to ensure it is as strongly as they had predicted. Now, we're going to touch upon some of the new AI chips that they are releasing over the next few years as well. They look incredibly strong and the demand is there. In fact, they already have a massive backlog. And again, we can see just from that latest quarter, 612 versus 559, and the revenue as well, a very strong double beat. Now, when we take a look at what the market is expecting and what we have seen in the previous quarters, we can clearly see every single quarter these numbers from Q2 FY23 all the way down to the more recent quarter. There has been an increase every single quarter, and a lot of this has been driven from the data centers, as we can clearly see. In fact, Q2 of FY23, it was 3.8 billion. Now we're talking about 22.6 billion. So definitely something we do need to keep an eye on when we do get that earnings. And what we can see here from one of their latest presentations is the fact that quarter on quarter, not only do we see their revenue numbers go up, which is a very strong sign of a company that continues to grow, but also their margins. So they are improving their essential efficiency, increase to revenue, increase to margin. It is a very deadly combination, something that you see of high quality companies. But the question will be, when they do release Q2, are we going to see not just the revenue, which is very likely to increase, but also the margin, which now sits at 78.9%, move in the upwards direction that investors will be hoping to see. Now, for some very bullish news, just yesterday we see that Samsung are expecting a 15-fold profit given the AI boom, and they essentially talk about that over the next few years they're anticipating 30% of the global chip market to be made up of AI chips. Again, very bullish, not just for the industry, which is very obvious, but also for Nvidia. Now, another thing we want to point out, again, some more bullish news. They are estimated to make around 12 billion from AI chips just in China this year, which is very, very big. One of the reasons for this, one of their rivals, as we can see, they're estimated to deliver more than 1 million of their new chips, and we can see this is almost twice as many as the Chinese competitor as well. Very bullish, in fact, that China aren't buying as much from their local company. They are buying them, in fact, from Nvidia. In fact, almost twice as much, so a very big sign of things to come. Again, what we want to understand is, can that demand, can that backlog continue to be filled? Will the numbers continue to rise? Because that is the ultimate question, whether or not we will see the share price continue to increase like we have seen in the past. Now, not everything is always going to be positive with Nvidia, and as we can see, their share price target was downgraded by an analyst. As always, analysts will increase, decrease. Not something we say you should always look out for. Always interesting to see that they did downgrade it to a neutral from what was a buy. Their price target, although higher than the current trading price, very minimal, $135. And they talk about essentially the value of this company has everything baked into it in terms of the growth over the next few years. Just something we want to point out. On top of that, we do note a lot of insider selling. 4.23% is that ownership, and we've seen 549 million worth of sales over the last 12 months with 8 insiders selling. Now, it isn't something that has happened for the first time. In fact, you have to go back all the way as far as Q3 2023 to see one quarter where insiders haven't sold. But the main thing we want to point out from here is that if you do see news that the CEO has been shedding shares, that is correct. In fact, we can see a lot of tranches just over the last few months of 120,000 shares, which each one roughly nets him around $15 million. The point to take away that we wanted to say, this is something that was already pre-planned and is only a very small portion of the stake that he does hold within his company Nvidia. Now, to flip this into a more bullish signal, what we do see with institutions, 65% ownership, around $8.5 billion worth of sales over the last 12 months, but we see a significant amount more buying over the same time period. On top of that, what we want to point out, always interesting to see, the more recent quarter, $1.43 billion worth of buys, 77,000 worth of sales. So institutions just over the last few months have been buying an incredible amount. Although they have sold barely anything, this number is fairly trivial. So something very interesting to understand. But as we always say, and it does take some very importance with this company, always do your own due diligence. Never buy, never sell because insiders or institutions do. It is just one layer of review that we do on the channel. A few more things to highlight with this company. Their net debt to EBITDA metric, which always signals on how strong the balance sheet is 0 across the board. What we typically look for is below 1.5 for semiconductor firms. This essentially tells us that it wouldn't even take them one day to pay off all of their debt net of cash on hand, as that is what the numbers below represent. So a very, very strong balance sheet. Always a great sign, not just for semiconductors, but for any company when you do see 0 across the board. Next thing we want to show, because free cash flow is very important, consistent increases is what we're after. Now, they're not consistent given the nature that just over the last few years it has rapidly increased and the expectation is there over the next 12 months. But what we want to point out is that the free cash flows over the longer term with Nvidia are anticipated to increase, a very good sign, but something we should also monitor over the next few quarters and the annual report to ensure this trend continues. We then take a look at the ROIC, absolutely phenomenal metric that we should always consider on any company. We want to see 10% or more, 12 or more for semiconductors. Give us faith that management are able to effectively allocate their capital, not only above 12%, but just in the more recent year, 61%. On a trailing 12-month basis, 78%. Absolutely phenomenal, and this is a super attractive metric for any potential investors to see. But as always, valuation will be very critical, which we will touch upon soon. The next thing we have to point out are the margins, which are very strong on the operating side. It is above the minimum 16 that we want to see. In fact, we'd call this operating efficiency, as it has increased over the longer term, 60% on a trailing 12-month basis. The same to be said for the free cash flows, very consistently high, 45% in the more recent year as well. It does make this very attractive again, especially if we can see those margins continue to climb over the next few quarters and beyond. Then from their latest annual stockholder meeting just a few weeks ago, they're pointing out here that the growth has been very strong. Year on year, 126% on the top line. Gross profit margin, 14.6 percentage points. Operating income, triple digits. Earnings per share again. And as we saw, just over the next quarter, they are anticipating this to be very strong as well. In fact, as we did say here, 135%. So hopefully if we do see this and it is even a little bit better than what has historically shown, then we are in for a very good surprise, hopefully towards the upside. Finally, we just want to point out that they do keep talking about a new industrial revolution. They talk about AI factories, they talk about their chips, Blackwell, as well as some others that we're about to come on to, and importantly, robotics, how going to be fueled and helped by Nvidia. Now, before we move on to the valuation, what we can see here from this investor presentation, they're talking about looking ahead. One thing that we always have to understand, we always look at numbers, but sometimes looking at management is a very good indicator of whether or not we should be considering buying a stock. Now, what they're talking about here is in 2024, this year, they are selling the Blackwell GPU. They already have a backlog for next year, 2025, whereas the Blackwell Ultra. But that doesn't stop there. 2026, they have the Rubin GPU. With each year, the efficiencies improve, and we can see 2027, the Rubin Ultra GPU. So always with companies, one thing to consider is management. Do you believe that management are capable of performing? And you can always look towards the historical performance of how well they performed, as well as looking to the future, what they expect, and whether or not you believe that the guidance is fairly reasonable. Just to let you know that on Monday we will be releasing 49 Dividend Kings. We're going to run through each one and you're going to be able to see the upside, whether or not we believe them to be undervalued. And if you are a subscriber of the free weekly newsletter, you will be able to gain access to that free spreadsheet, as well as by signing up on the below pinned comment, you will get access to all of these other articles. Again, it is completely free and the access is instant. We need to talk about the intrinsic value, how we got to it, and the estimations for 2025. So we start off with the DCF model. We have those free cash flows year on year. The average growth rate at 94%. Now with our discount rate, we have used the 30%, which as you can see here is our medium rate. Based on that, we do get the present value of those future free cash flows, which we add with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get that essential intrinsic value, which does show 12% upside. Now, for those that believe 30% is way too high, then we have used that 25%, just to show you it would give you an overvaluation, therefore leading to downside of 19%. With 35%, we can see this would ultimately be $192 with upside of 54%. One thing that we want to talk about, whilst we have seen this article before, Bloomberg are talking about a compounded annual growth rate of essentially the market 42% over the next 10 years, talking about how AI is going to be a 1.3 trillion market. Now, if this is something that you believe, 40% isn't something that you would say is too optimistic, and we do get earnings and we do see that they are moving in that direction, while 40% would indicate that their intrinsic value would be around $260. So for example, if we get the earnings over the next few quarters and we see they are leading in towards that direction, then it could be reasonable that a 40% growth rate is accurate. But as always, we like to be a lot more conservative on this channel, hence why we have gone for that 30% level. As always, you can click on the pinned comment below if you do want to grab a copy of this model, put your own numbers through, whether or not you actually believe these numbers are way too high. You think 15%, therefore it will be significantly overvalued, or if you believe, you know what, 45%, again, you see where we're going with this. So as we said, we're going to move the essential rate to 30%. We're going to take it through to our intrinsic value, which as we saw, $140. Current price at 125. We do like to use an MOS level at 10% start off with, and we execute on that if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that for Nvidia, well, look, it does look to be a buy at around $126, so that does indicate right now, based on the trading price, you are getting a 10% MOS. Now, for those that believe they want a larger margin of safety, well, at 15%, you would have to wait to $119. At 20%, it would be at $112. But as we mentioned, today's episode for Nvidia, you are getting a 10% margin of safety. In terms of Wall Street, well, they do see upside, 10%, $137. There are many different analysts with a wide range of price targets, so we have gone for the average around 137. As we said earlier, some analysts have started to downgrade it to a neutral from a buy, but there are also some other analysts with some very, very bullish price targets over the next few years. As always though, do let us know your thoughts. Do you believe that this is reasonable for Nvidia over the next 12 months? Do you believe that their free cash flows will be going a lot higher? And as always, let us know, are you looking to buy? Maybe you're looking to sell, or maybe you're someone who has on this on the watch list with a margin of safety at a lower rate than the 10%. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.